Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Matt, we're down here at the broadcasting live from Commonwealth's 2023 National Financial Advisors Conference. We're at the Gaylord Rockies Resort in Aurora, Colorado, literally right next door to the airport. I mean, planes are flying over, flying out. It's and for somebody who likes planes, it's a great place to be here. We're joined here at the conference down here by Trap Kloman, COO and President of Commonwealth. Trap, thanks so much for joining us. Thanks for having us down out here in Denver. Talk to us about Commonwealth. You guys have got, it's like 2,000 financial advisors. Mm-hmm. What do they need from you guys? Because these markets are very, they're very difficult to navigate. You have equities, fixed income, alternatives. How do you try to help your RIAs out there?
Yeah, it's a fascinating and endlessly challenging opportunity for us because so much is continuously changing, both in the financial markets. Frankly, technology has become such a big part of any business, but especially for financial advisors. And then, of course, you overlay regulation. So as you think about the opportunities we have, it's to be a great business partner for these RIAs and duly registered advisors who really, their greatest opportunity, their greatest value is their relationship with their clients. So if we think about our role in the ecosystem, how can we maximize their time, their opportunities to spend time with their clients? We look through our research team to take on as much of that work as possible, and especially in these markets and volatile global political events, bringing our economists to bear to help them navigate that. Really build a lot more portfolios, bring more technology so they can do research faster, trade faster, and then white label and communicate it out to their clients so they can really present themselves rightfully as subject matter experts and really tying personal needs on an individual level to the marketplace. And I just think that's a fantastic service that they do for over 500 households in America, and we're very proud to be a part of that.
So when I talk to some of the RIAs around here this year and other years, they say, man, the back office stuff is really consuming more and more of my time. That's where I need some leverage so I can talk to my clients, so I can really provide some value-added advice. How do you guys try to address that?
Yeah, that's exactly it. And it's only growing. If you look at some of the rule proposals right now about protection of consumer data, which we fully agree with, but the difficulty in navigating that and managing the technology. So one of the values of having scale and being in the business that we're in, we can focus on the complexity of trading, of compliance, of technology. And RIAs, if you look at the history, it really started upstream with large institutional RIAs. And what's great about what's going on in the industry is that's been moving downstream. But as it goes downstream to smaller, more retail-focused RIA shops, there's greater need to outsource more of those capabilities to subject matter experts. And we have the size and the scale to get incredible technologists, incredible InfoSec people, great people, again, in our research teams, if you will. So we really look to surround them on every way possible, and then be there to meet them in their needs, because every advisor is also different. We don't take a cookie cutter approach.
They're all different, but what's the average size of the RIA that you guys are supporting, and is it easier now for them to compete with the big banks than it would have been, say, 10 years ago?
Yeah, absolutely. So we have over 2,200 advisors, but they're in about 900 offices together, and so we tend to measure productivity across those offices, and it's about 240, 250, depending on the markets, million on average per office. And so outside of the wirehouse landscape, we have the largest producers in the industry when you start to look at the regionals and independents and some of the insurance and bank place. And one of the reasons we have been so successful, I love the question, is because a lot of the capabilities that used to only be accessible in that bank, the wirehouse, the large bank environment, are now available much more broadly. And individual RIAs, can't necessarily access that on their own. And so there are more and more business partners who are bringing more alternative investments, banking capabilities, more sophisticated trust solutions, high net worth, absolutely. And having a monopoly on internal product in a fiduciary world isn't an advantage anymore. So I really like kind of the democratization of what's going on in the industry, and it's really given advisors a lot more choice and flexibility in how they do their business, which is obviously great.
Why does, and I read about this, I've been on Wall Street for over 35 years, and it's been a constant trend. Advisors leaving some of the big wirehouses and going out independent, and it kind of, I guess, it ebbs and flows in terms of the pace. What's the general reason why an advisor would leave a Merrill Lynch, a Smith Barney, and kind of go out on his or her own?
Yeah, the reasons have changed and evolved and fluctuated over the years. But one of the constants has been ultimately you are now an entrepreneur. You own your business. And one of the fascinating trends, one of the great trends going on in the industry is the value of those businesses is going up significantly. So I expect to see that trend rise because when you're, as an employee, you're obviously paid your salary. Hopefully, they treat you well on the way out. But ultimately, it's the bank's book.
Yep.
It's the bank's clients that they're going to push it back out to all of their other employees. When you've broken to independence and you own your own shop, you can monetize that business for great value. And so if you think about your own financial planning, you're getting a higher payout, and you can sell your business at the end. Financially, it just makes a world of sense. And then the other big trend is advisors really like having the autonomy and the flexibility to make their own decisions and put their clients first. And not to say that isn't necessarily happening in the employee model per se, but there's a lot of competing priorities in that type of environment when you're an employee, and also especially of public companies. When you have the opportunity to go independent, you're your own boss, and we're a partner for you. You don't work for Commonwealth. We support you.
What's a typical kind of, I guess, asset allocation for one of your RIAs? Is it, stocks and bonds, or is it also alternatives? I guess, how sophisticated did they get? How far away did they get away from that 60-40 portfolio?
Yeah, the 60-40 portfolio is definitely evolving, but it's more in the construct of it. So I think the end result is greater diversification. But you're obviously seeing much more use of ETFs and mutual funds for greater tax efficiency, much more demand for SMA solutions.
What's SMA?
Separately managed accounts.
Okay, got it.
Where you can have individual holdings within a portfolio, a managed portfolio or an index, but then you can self-select a little bit. So if you have some preferences that align with your goals or beliefs, or you have some holdings that you don't want to part with because of tax consequences, but you want to jump into a model, you're not forced to sell out of your position just to adhere to a model. So it gives our team and our advisors the ability to really make many more investments, much more individual, customized for their investor. And so, at the end of the day, we're seeing steady growth in SMAs and which ultimately hold mutual funds, ETFs, stocks, fixed income, but also greater growth in alts. I mentioned a minute ago how the democratization RIA is moving downstream. The same with the investment product. The mass affluent American has now far greater access to alternative investments, and funds of funds with private equity and hedge funds. So we're seeing greater demand there and opportunity, which is great.
So what's your view on the economy given your position there, Trap?
I have far smarter people than myself who spend a lot more time on the economy. In short, the way I try and think about it is if you are chasing, whether it's the markets, interest rates, or the economy, and trying to run your business solely in that moment, you're often going to be left behind. How we like to manage Commonwealth and work with our advisors is see through the economic variables and the market fluctuations and the interest rate volatility. Plan long term. As best you can. And of course, you have both businesses and clients who have immediate short-term needs. And then, again, the people who are far smarter than myself come to bear and can really help out in those situations.
Trap, undergrad from the University of Virginia. I'm a big fan of the Wahoos. 1-5 in football.
Yeah, I was
the Cavaliers.
No, hopefully not the football team.
Yes, the Wahoo.
Yeah, go Who's. But yeah, it's it's real hard these days, and it's been hard for a long time. My daughter just went to Syracuse, though, so I was all ready to follow Syracuse as well, but they're struggling too. So I guess I have to wait till next year.
Yeah, exactly. But you always have a basketball season as well. What's that, the Paul Tudor Jones Arena?
John Paul Jones.
John Paul Jones, yeah.
Yep.
Okay, awesome. Very good stuff.
Yeah,
All right.
beautiful place.
Yeah, it is. All right, Trap Kloman, thanks so much for joining us. Trap is the COO and president of Commonwealth. They are sponsoring this conference here in Denver, Colorado, just outside of Denver in Aurora, Colorado. Some good stuff out here.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Matt Miller, he's in that Bloomberg Interactive Broker Studio in New York City. I am here live from the Commonwealth 2023 National Financial Advisors Conference. We're at the Gaylord Rockies Resort in Aurora, Colorado. And Matt, I can report that the sausage biscuits are to die for here. Awesome. Fire you right up, get you set for the rest of the day. All right, let's talk to our next guest here, Vance Barse. He's a wealth strategist and founder at Your Dedicated Fiduciary, YDF. Vance, thanks so much for joining us here. Tell us what you guys do at YDF.
YDF is a family office-style fiduciary financial planning firm that discretionarily manages assets for our 67 families, which are all around the country, and our focus really is in the advanced planning area. Prior to founding my firm 8 years ago, I spent a decade traveling the country full-time, specifically consulting and teaching private wealth managers on how to invest for their high net worth clients. And I realized that much of the industry, unfortunately, doesn't focus on advanced planning, and that is why I started our firm.
Hey, Matt, Vance, he's part of that financial mafia there, Danielle DiMartino Booth, David Kotak, all those folks.
Camp Kotak.
That we know, so he goes to Camp Kotak, absolutely. Hey, Vance, I'd love to just kind of get you. We love talking to Danielle and Mr. Kotak, and kind of like to get their views. So when you go up there and you chat with those really smart folks about the markets, if you had to go up there today, what would your call be right now, just in terms of the markets, the economy? How are you looking at things?
It would be the same call that I had a couple months ago when I was attending Camp Kotak, which was amazing because I have read and corresponded, with these folks, and then to be a peer among them is just truly amazing. I'm in the higher for longer camp, which is an unpopular view.
Higher inflation, higher rates kind of
yes.
thing? Okay.
Yeah, very much so. And there's rationale to that. My view is that the economy changed during COVID, and there's this collective, palpable belief, not only among our clients, but also the investing public, that because of the interest rate raises vis-a-vis the Fed starting in March of 2022, that unemployment is going to spike and that we're going to have this recession and it's going to be horrible and that the Fed is going to cut rates back to zero, launch the printing press again. And I fundamentally disagree with that. During COVID, people age 55 and older were able to retire.
That's me, man.
Largely, hey, you know what? It's a pleasure to be here,
Yeah,
right? I'll get there
exactly.
someday, I hope. I'm in no rush, by the way. But in any event, they were able to retire because of the largesse of their nest eggs, which was a product of the 13-year quantitative easing, zero interest rate policy era that we had. People 30 years of age and younger were able to move back in with mom and dad and go back to school. So how human beings behave has materially changed, and because of that, we have a different economy, if you will. If the Fed were to come out and cut rates now, my view is that it would reignite inflation and we would be in this sort of vicious cycle. So if we look at the real rate, which is interest rates minus inflation, we're at about 2.5. Over the last 5 decades, what has it been? About 2.5. So we believe that we're not going to see a precipitous drop, and that because of that, the investment landscape has in fact changed. But there's opportunity there.
What do you think about, Paul's been asking this allocation question. I heard the surveillance team talking about it this morning as well. 40-60, where we're supposed to see a comeback, and it seems like bonds and stocks are moving the same direction every day. How do you solve that problem?
Interestingly, cash is no longer trash because of the interest rate environment that we are currently in. Clients have come out and pointed out the fact that we can really have a great return stream in money markets and or T-bills. There's this funny term, T-bill and chill. We were an early adopter to the T-bill trade, having largely blown out of bond mutual funds in December of 2021. So if you rewind back, the Fed, the White House, the Treasury were all saying inflation is transitory, inflation is transitory, inflation is transitory. When you hear that messaging consistently over multiple months, yet the inflation data keep increasing, maybe, just maybe, it's not transitory. And we all know the rest of that story. When we look at the correlation between equities and fixed income, it is important to diversify, but we have to go back to the pre-COVID era playbook and understand how to deploy across equities and fixed income and real estate and so forth. So given the interest rate environment, we think we're pretty close to the Fed largely being done. That creates an opportunity for getting back into specific types of duration, whether it's individual issues or some bond funds or even potentially ETFs. Regardless, we're going to be long duration here in the next 3 to 6 months, depending on how it plays out.
All right, so we sit back here and we've got a Fed that I guess we're high. I'm in the camp that's just kind of high for longer, and I think eventually they're going to cut because I need to refinance my mortgage I just took out. When you talk to clients, one of the things I hear a lot when talking to private wealth is family offices and kind of just tax planning and estate planning. I mean, do people get that right yet? I mean, do people you talk to, are they savvy enough to kind of deal with that?
No, and having spent thousands of hours inside of wealth management firms and with financial advisors for a decade, that was my largest observation. There's a huge generational shift in terms of asset transfer that's going to happen from the boomers to largely Gen X, but also millennials. And people like to make jokes about millennials, but let me tell you, they're a very purpose-driven cohort. They're really smart. They grew up with technology. They really don't need to have help selecting ETFs. The real alpha, if you will, is in the advice idiosyncratic to the family. And my cry to the wealth management industry is to bring maximum value by way of incorporating true tax planning. For example, a financial advisor cannot bring maximum value to a family unless they are literally looking through and analyzing the tax returns. I liken it to this. If a client has ever been to a medical specialist, what's the first thing they ask for? The general health history from the GP. Well, I need that. I need the equivalent of that, which is the last 3 to 5 years of tax returns, so that I can look for different planning opportunities. Big planning cliff coming up, which is the sunsetting of the Tax Cuts and Jobs Act. And that will happen December 31st of 2025. We're going to blink. It's going to be here. But the current estate tax threshold will be cut in half. So the largest underserved cohort in the wealth management industry is that $1 million to $25 million liquid profile. Why? Because many of the retail financial advisors, and I'm talking old guard retail financial advisors, don't have the advanced planning technical expertise and acumen to understand certain things like idiots and islets and grots and different types of grantor trusts and so forth. And if you're one with a really high-level money problem, which is having $25 million liquid, a lot of the private wealth firms don't focus on you because their minimum is $50 million and above. I mean, these are big numbers, right?
Yep.
But there's a huge opportunity, and one of the great things about Commonwealth is that there's a big push for the advanced planning area with respect to bringing maximum value.
All right, so I got to go to this because this is a theme I've been going on. University of Maryland, the worst conference decision of all time for you guys to leave the ACC. And it set off 25 years of disaster in college sports. 25 years later, what did the Terps feel about their move leaving the ACC for the Big Ten?
I'm really sorry to disappoint you. So I love San Diego, California very much, and I grew up in Maryland, right?
Yep.
Native Marylander, not crabby, I might add. But I had moved to San Diego at 19 and realized that if I stayed, I probably would never go back to school. So I went back to Maryland, to the University of Maryland, because they have a great neuroscience program.
Yep.
Seldom do I use my undergrad degree in neuroscience. But then again, I use it every day when looking at portfolios and estate planning and tax planning and so forth. But I couldn't tell you the first thing about the Terps. Because as soon as I graduated, I went right back to San Diego.
Smart move.
Life had a different plan, and I ended up in institutional investing and then here.
Good. Awesome stuff. Vance, thanks so much for joining us. Vance Barse, he's a strategist and founder at YDF. That's Your Dedicated Fiduciary, working with a lot of the folks here at Commonwealth, a lot of the RIAs at Commonwealth.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Talk now about politics, though, because yesterday the GOP chose a Speaker of the House candidate. It's not been brought to a vote on the House floor yet, and may not be brought to a vote on the House floor this week. Wendy Schiller joins us, professor over at Brown University. Wendy, this is obviously a gigantic mess, and I noticed today that there's a few never Scalizers, which I think that term is meaningless because, of course, they'll vote for Scalise if they get what they want. But one of them is George Santos. So we're in a position where the Republicans have to bargain with George Santos to get their candidate elected as Speaker of the House.
Well, you're raising a really interesting point, because also any measure to expel, because the House can expel its own members. It can censure, but it can also expel. And so any measure to expel George Santos requires that there be a governance structure of the House, that there be a speaker in place. Now, the interim speaker, Patrick McHenry of North Carolina, he can do that. He can convene the House that way. So they could actually try to kick George Santos out before they have repeated votes on the speakership. This is an absolute, to me, a crisis for the congressional Republican Party, but not necessarily for Donald Trump or Ron DeSantis or Nikki Haley or Tim Scott or any of the other contenders for the presidential nomination. So there's pressure on the Republicans, but it's really, how do you keep the House? And are the voters of California and New York, who really gave the Republicans the majority with additional seats and flip seats in 2022, are they going to be happy with this and put up with this? Or will the Democrats manage to put a moderate up in those races and take those seats back?
One of the other things I noticed, Wendy, we all talk about the fact that maybe the Senate needs to come down here and put an adult in the room, right? But even when, Kevin McCarthy does a bipartisan deal, and of course he's punished by being thrown out of that position. But even then, what the adult in the room is allowing them to do is spend recklessly like children. So it's like there's no good solution, right? Either they're shut down and not governing, or they're governing but spending like there's no tomorrow. What's going to happen?
Well, when you say spending like there's no tomorrow, there was a debt ceiling deal. And the
I'm saying if you keep running $1.5 trillion deficits and we have $33 trillion in debt, that's not the way you should run your finances.
So what's interesting to me, though, is that the choices that are framed, I think, are a false dichotomy for us, for the American people, for everybody, right? You say to yourself, oh, well, you have to cut this kind of spending, but we still want to have tax cuts and give money back to the American people. But the American people also need a national defense. They need roads that aren't going to destroy their cars. They're going to need some sort of mass transportation. They're going to need climate help to adjust to climate change. They need disaster relief. How do you pay for all that? You can't cut all the revenue and still pay for all these things that Americans are used to, not to mention the big entitlements, which, as you well know, are about 30 to 40% now of the federal budget, which are just, you can't touch them, right? So
but why? Why can't we touch them? And how much longer do we have enough money to pay Social Security without borrowing?
Well, I don't know. I'm old enough to remember, the last two times Social Security was in crisis, and they came to terms. They raised the age. They raised how much money we have to pay. One of the good things, I think, is that income levels are now adjusted for inflation. They go up in terms of how what income level is the cap on paying Social Security. You can raise that cap quite a bit more and still generate money. People are living longer. We want great health care in America. Therefore, we want everybody to have it. I don't disagree with you that cuts need to be made. And in particular, the Democrats have a problem because they want everything from the federal side. But in fact, it's easier to hold things accountable sometimes at the state level. It's closer to home, theoretically. I'm a tiny state, Rhode Island. We have a huge budget. We can't keep track of all the money. So government itself is, you can argue, unmanageable and inefficient. But targeting programs that actually affect the people who need the money most is probably not the smartest way to make government work better. And they're just so polarized they can't see straight. But I don't see any of the people, including the 8 people who are blocking the speaker, turning down federal money. Some states are trying to do that because they don't want to implement policies. That's, the state government. But those federal Congress people are not saying no to the highway aid. They're not saying no to the disaster aid. They're not saying no to the fundamental things that the federal government funds. So there's also a fair bit of hypocrisy that runs rampant, not just in the Republican side, but the Democratic side as well.
Hey, Wendy, let's switch gears a little bit and focus on Israel. It was quite the past 2 or 3 days for President Biden. The administration, Secretary of Defense Blinken is in Israel as we speak. How do you kind of view the Biden and the Biden administration response so far?
Well, there's the national security element, of course, anti-terrorism, and I think many people have equated the sentiment in Israel to the one that we experienced after 9/11. So the shock, the destruction, the loss of life, but there's also a tremendous amount of loss of life now in Gaza, militarily people, but also Hamas, but also civilians, many civilians. This is a really difficult time for the Democratic Party politically because the very left wing of the Democratic Party, as we saw in New York last week, has been very vocal in their support for Palestine. And not as willing to criticize Hamas sometimes as other people. This is very delicate for the Democrats, who need every single vote possible a year from now. And how do you actually proceed with strong support for Israel if Israel continues to defend itself, but the casualties civilian-wise in Gaza increase? That becomes a problem for the Democrats. And, that's a very hard balance for the president. The sentiment in America is generally pro-Israel to defend itself against the terrorist attack. How long that lasts depends on how much involvement Biden approves in terms of the United States. No boots on the ground. I think there's no support for that in America. But what do? How do you give military support but stay within the boundaries? Biden has a lot of experience. And one thing Americans might want to think about is when you are electing the next president, how much experience do they have dealing with these kinds of crises versus having no experience with them? I think that's going to affect our presidential considerations as well.
I wonder if they can tie aid for Ukraine to aid to Israel, because a lot, I'm sure, of these, especially right-wing Republicans who don't want to help Ukraine defend itself against a Russian invasion, definitely do want to help Israel. Do you think they tie those things together, or is it insulting to do that?
No, I mean, you mean the Democrats putting those two things together?
Yeah.
I think strategically fighting against incursion and invasion might be a theme. And certainly Russia has been accused of atrocities, and Ukrainian soldiers have also been accused of atrocities. So I think it gets very tricky to do that, but it also limits the capacity for Republicans to be isolationists now, right? You can't say, we don't want to get involved, but we want to help Israel. That's just really hard to do, and independent voters in districts won't really put up with that, I don't think. So it puts the Republicans in a tough bind to say yes to Israel but no to Ukraine, and I think you're right. But I think to actively tie it together in a package has risks for the Democrats as well. But the pressure is on the Republicans to decide whether they want to sort of say no to being involved in anything, but then get credit for supporting a response against Hamas. So I think it puts pressure. And since there is no leader really of the Republican Party in the House right now, the spokesperson's Mitch McConnell on the Senate side, and we know that he's been having health difficulties.
But he has experience, Wendy.
He does have experience.
You're a fan of experience. Mitch has it.
Mitch has it, but there's a fair number of other Republicans in the Senate right now that do. And it's interesting to me how we, 1 year it's the Senate's fault. They're filibustering. Ted Cruz is shutting everything down. They're horrible. Let's get rid of the filibuster. Let's make it more like the House. And then the House falls apart, and we look to the Senate and say, oh, can't they save the day? So I think we have a crisis of leadership on all sides, more so right now in the Republican Party than the Democrats.
All right, Wendy, thank you so much for that. We really appreciate getting your thoughts there. Wendy Schiller, she's a professor at Brown University.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Well, we have Hessam Nadji here in the studio, I'm pleased to say.
Nice.
He's the president and CEO of Marcus and Millichap, and we're going to talk a little bit of real estate with him in the face of, rates that just continue to rise. Paul the other day was quoting, I think, the bank rate 30-year mortgage out to 8%. Which has got to put real pressure on a market where affordability is already off the charts. What does this mean for real estate?
First of all, thanks for having me on. Great to be back with you. The answer to that question, Matt, is a severe disruption in trading activity, in investors' ability to value real estate, and a lot of uncertainty out there. On the housing front, we're seeing anyone who has a low interest rate already decline to bring inventory to market or stay put, which is really reducing sales velocity there. As a buyer, the affordability has gone so out of control that people are renting apartments longer. They're staying in their apartments much longer than anticipated, and the renewal rates of apartments are actually showing really good rent growth. On the commercial side, it's not just the price dislocation, it's the fact that banks have pulled out of the market by pricing themselves out of the market, and other lenders have not been able to step in to make up for what banks normally do in financing commercial real estate. So there's a real logjam in the marketplace as we speak.
So on the housing side, on the residential side, there's just not any pre-owned houses trading hands, right? On the commercial real estate side, what you're saying is people can't get refinancing that they need, and so what? Are they forced to sell?
Well, the refinancing issue in and of itself is a serious one because the loans that are maturing today were issued 5 to 7 years ago. Thankfully, a lot of equity has been built up. A lot of rent growth has been basically achieved. So not every maturing loan is in trouble, but there is a pretty good chunk of the maturing loans, especially in office, not really so much any other property type, that is having to either be sold as distressed or having to get a workout between the lender and the borrower. The Treasury and the Fed have really pushed lenders to work with the borrowers to avoid a fire sale, if you will. So we're not expecting a huge wave of fire sale even in the office sector, but you're already starting to see some distressed sales in older office product. Newer office product is actually performing better than most people realize.
All right, Hessam, I am a huge bear when it comes to commercial real estate, and particularly the office space. I just think we have a doom loop kind of building here, where, the values of these real estates are nowhere near enough to support their debt, and it's going to become really apparent when we see some transactions cross the market and reset the market. So I'm wondering, have we seen anything in like New York, Chicago, San Francisco, LA? Like, I haven't really seen any big property in New York trade. And when it does trade, I'm afraid it's going to be at 30, 40, 50% discount. How are you thinking about that?
It really depends on the asset. Some of the assets that are going to trade will fall in the exact description that you're sharing right now. Older office product has vacancy rates in the 20 to 25% or higher. Newer office product on average, meaning the built in the last 15 years or earlier, is half that, about 11%. So there's a huge dichotomy. And the obsolescence of older office buildings, unlike obsolescence of shopping centers where you could knock down a shopping center or an old warehouse that is obsolete and have a reuse or reimagination, it's much harder to do that with older office product. So the reuse is one rescue channel. Another is just a pure discounting of the asset to what the fair market value would be. Believe it or not, there is a lot of entrepreneurial buyers of that product. We're actually helping a number of them either go directly to the lenders or wait for product to come to market. But the cycle will be pretty ugly for that older office stock that you're describing, Paul.
Yeah, what's going to happen to, Bloomberg Business Week did a cool piece last year about the 3rd Avenue corridor, which has a lot of that office space, with the problem that you're talking about. It's just unconvertible. There's no way to make it into apartments, and nobody wants to use it as office space. What happens? Do we just have a ton of storage space buildings all the way down 3rd Avenue and in the middle of Manhattan, some of the most expensive real estate in the world?
Here's what I predict. I predict opportunistic buyers will come and buy it, as Paul was saying, 30, 40 cents on the dollar. They'll upgrade it do a value add, and wait for the return to office to improve. It's never going to go back to pre-pandemic, but I also think we've come off the lows of people's resistance to come back into the office. Urban America is not dead forever. It's hit really hard right now, but those opportunistic investors, because of the basis points they're going to basically come in on acquiring those assets, or the price point versus replacement cost, have a much longer kind of a viewpoint on it and a time horizon than a 2 or 3 year hold.
So there's just a repricing then of assets. What's your view then, and this gets big, this is like 35,000 feet, but what's your view on the cities of America?
Well, urban America is taking it on the chin, no question about it, whether it's Chicago or San Francisco or Seattle or anywhere else. Now, if you look at Miami, if you look at even the comeback we were seeing in somewhere like Seattle versus San Francisco, Chicago, or New York, you can see that the comeback can be affected in those other markets. It's just going to take a lot of time. New York, adding 100,000 jobs in the last 12 months, is actually much better off than other urban areas because we are creating those jobs and a lot of young people want to live here.
Yeah, that's pretty... Well, we haven't got the congestion charge yet, so just wait for that.
Right.
Then John Tucker's going to be staying home and doing all of his broadcasting from the shore.
But Matt, one thing to add is there's such a judge the book by the cover. Everyone's talking about commercial real estate as though the whole industry is older office buildings. And older office buildings are an important segment, but office, as I pointed out last time I was on the air with you guys, makes up 15% of the total outstanding commercial loans. And if you look at the entire commercial real estate industry, it makes up 24% of the total bank loans outstanding. So it's a much smaller percentage of risk than people realize. And we're concerned that this perception of older office is going to affect financing for self-storage units or shopping centers even, or apartments that are doing much better.
So I was going to ask then, looking at the whole pie of commercial real estate, and office space, as you're pointing out, is just a fairly small piece. What are the parts of the pie that you like?
Well, 50% of the outstanding commercial loans held by banks is in multifamily. 95% occupancies. Rent growth has flattened out after jumping almost 30% in the last 3 years, so it's taking a little bit of a breather. And within multifamily, we have a lot of assets that were financed on short-term financing with debt funds in the last 3 years that are already coming due. They're having some problems refining as well, but nothing like the office market.
But do you see opportunity there then? I mean, in multifamily, if you get a good deal, a low valuation, do you go and snap it up?
Absolutely. For any property that on an equal-to-equal basis is coming to market 15-20% below peak pricing as of March of 2022, we have multiple bids, multiple offers for those assets.
All right, fascinating stuff, Hessam. Thanks so much for coming in. Always appreciate you stopping by. Hessam Nadji is the president and CEO of Marcus and Millichap.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're broadcasting live from Commonwealth's 2023 National Financial Advisors Conference. We're here at the Gaylord Rockies Resort in Aurora, Colorado. Joined next by Shelby Trinkino. She's a certified financial planner at Independent Wealth Management. She joins me here at the conference here in Colorado. Shelby, so we'll talk about the markets and stuff like that, but what I find interesting about your background, you've been into business a long time, but you lead an all-woman team of financial advisors. Now, I do see in the mix here a lot of women here, but tell me, what's the percentage of women in kind of like in your line of the business, financial advisory business?
Yeah, thank you, Paul. Good morning. Right now, the statistics are still under 20% women financial advisors in our industry. We haven't grown the way we'd like to have grown, certainly in the last 10 years. So we're working on that.
So I guess the issue here is, for a lot of folks, is when we get people into these financial services, I've had a lot of experience in recruiting. At the entry level, you get a lot of diversity because it's easy to go onto a campus or something and find a diverse incoming class. But then 4, 5, 6, 7 years later, when it's time for the promotion for leadership positions, it's not so diverse anymore. Do you find that in your experience as well?
Yes, we do, and we're trying to change that. I'm not sure we know exactly why that is. Certainly there's some extra pressure to, run a financial planning practice, investment firm, along with everything else you want to do personally. So.
Yep. All right, so let's get to your business here. Talk to us about just what you're telling your clients these days about these markets. Last year was a tough year, whether you're in equities or you're in fixed income. This year's a little bit better, certainly on the equity side if you're in the right names, I guess. Well, what are you telling your clients these days?
Yeah, this has been historic. I celebrate 40 years in the business next year, and I think that 22, having the combination of the stock and the bond market in negative territory, the average balance fund down 16 to 18%. It tested the best of the best. We do our best to assess where a risk temperament is with our clients and run through the respective, tests on that. But this past year, we found out where the risk temperament really was. So we're telling them, we got to take a deep breath with this. We're huge proponents of having emergency cash set aside so that we can actually allocate a portfolio of quality investment holdings to see them through on their short-term, medium-term, long-term goals. But this has been such a balancing act between the technicalities of this market and the emotional wherewithal. So it's been a heavy lift.
So do you still, how do you diversify a portfolio now, or how do you protect against correlations?
Yeah, that has been an interesting challenge. Obviously last year, where we've historically relied on the bond market to stabilize the portfolio and create that income stream, we couldn't go there. And so there was heavier cash positions. We look out in every sector of the market to determine, that risk-reward temperament, and it's been, a combination. So there's some, solid dividend-paying stocks in there. We've got some commodity exposure. We've tried to keep it simple. I, historically have used some of the more advanced instruments and not always been rewarded for the extra expense we pay internally.
You could go, I've been telling people after 2022 where there's no place to hide, equities down double digits, even most fixed income classes down double digits, which had never happened before. I can sit here at a 2-year treasury at 5.07%. Even my 27-year-old daughter called me up and says, I'm going to go put some money into a high-yield savings account for Marcus. So she's already playing the markets, and she's in the music business. So I can sit there in some of these relatively secure places and get a decent return.
Yeah, so you know what? And Marcus has been a solid place for short-term money and emergency funds. That's an easy call. So for maybe short-term emergency funds, great. But we got, it's time to dip your toe in.
Yep.
And I think keeping perspective in this environment is the most important thing. And with all the noise that we've got going on out there, that's really hard to do.
All right. So what are so if I want to if I came to you and I said, I have 60-40 portfolio sounds reasonable to me. What stocks would you look at, or what sectors would you look at, or how would you think about that? If I said, I've got my 5 and 10 year horizon.
Yeah, Paul, I think it's actually we love growth. this AI, it's real, but I think at the end of the day, you have to be balanced. The heavy, we've relied on the large cap space for the bulk of the returns, and I think it's time to make sure you've got the mid cap and the small cap exposure for the next wave. We look at that 100-year chart of this market. We've been through really difficult times before. We're going to get through this. You got to be positioned to be able to take advantage of it.
You guys, and I'm sure everybody in Colorado is in fantastic shape, but the rest of America needs a little help. you mentioned AI, and it makes me think of what I've come to dub AI Junior, and that's the GLP-1 drugs. What do you think about that? Is it really like a strategy-changing development, or is it just fun for us to talk about in a few stocks?
No, you know what? From the sounds of it and everything I've read, it sounds like it is a real thing. And I think, the innovation that we're seeing in the healthcare space and also in the automotive industry is pretty mind-bending. So, used properly, I think AI could be enormously impactful.
Hey, Shelby, thank you so much for joining us. Shelby Trinkino, certified financial planner or independent wealth management, independent wealth strategies, joining us here at the conference in Aurora, Colorado.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're bringing Peter Essele. He is the Senior Vice President of Investment Management and Research at Commonwealth. And Peter, I spent a long part of my career in equity and investment research. Tell me how you guys do it at Commonwealth.
Sure, absolutely. Thanks for having me. So our role is in support of roughly 2,500 independent advisors, where we cover everything from individual equities to mutual fund research to credit analysis on the fixed income side. And what we've seen as of late is that there's been a strong interest in creating model-based solutions. So we've really partnered with a lot of our advisors, acting more so as like an outsourced CIO capacity, where we support them in their model construction efforts, monitoring, and so forth. In addition to that, there are a number of advisors who have elected to outsource investment management to us, and so we directly advise over $12 billion in assets, and then advise on another about $150 billion or so.
Wow. Okay. So, what's a typical? What's a typical ask from an RIA from you guys, from your organization? Is it to say, hey, should I buy Apple, or is this AI thing for real? What kind of requests do you typically get?
Absolutely. Honestly, it's anything under the sun at this point. Okay. Everything from AI stocks to the latest and greatest, to going back a few years ago, looking at cannabis stocks. And what we've seen recently is a lot of advisors looking for a red flag analysis. So that is everything from taking a deep dive into a client's prospective portfolio that comes over, looking at structured products, individual equities like you talked about, in addition to just general outlook and commentary around the direction of the economy. So obviously with inflationary concerns persisting pretty heavily as of late, they want our views on interest rates and what that outlook looks like and how that should be reflected in their portfolio positioning related to duration and so forth. So honestly, it runs the gamut from individual security analysis all the way out to views on the markets and the economy.
So what's a red flag? I mean, is that like if I think 2 years ago weed stocks are definitely screaming buy because I see that revenues are picking up in the states where they're legal, and I feel like it's time to get in. But you come back and say, well, they're not federally legal yet, and they can't do any banking, so this would be a very bad idea.
It can come in that form. It generally involves a look into security as it relates to a client's investment risk tolerance. So, for instance, if there's a high concentration in distressed debt for an 80-year-old investor who has very little assets and has a conservatively positioned risk tolerance, that would be a major red flag for us, obviously. But there are instances where, yes, on a security-specific basis, where you have sort of these thematic plays that are very binary in nature, where they can either soar to the clouds or basically turn out into pennies, that would be a red flag for us as well. But generally, it relates to the client's risk tolerance.
So what are you telling your clients these days about I don't know, just kind of, do you have like a market call here that you guys are pretty constructive on the equity markets or not? So how do you kind of frame it out for them?
Yeah, generally we try to deploy a 12 to 24 month outlook, and we often try to sift through the noise. And a perfect example of that would be March of 2020, where obviously there was a lot going on. Markets were down. I believe the S&P was down over 30% in the course of a month. And that's an environment where we tend to get a little bit more optimistic and like to add risk into our portfolios. And we did so in fact, it was on March 23rd, 2020, where we added equity exposure, roughly 800 basis points for a 60-40 portfolio. So we like to look for those opportunities of volatility when investors are rushing for the exits. We're generally rushing in. But as far as our outlook at this point, there's clearly a lot going on the geopolitical side of things. Again, we like to look through that noise and deploy that 12 to 24 month outlook. And we are still optimistic heading into this year. There were a lot of economists out on the street saying that this was the year of the recession. This was probably the most anticipated recession in my career, and we sort of took the opposite of view to that, where we saw more of the Goldilocks economy scenario, which thankfully has played out year to date. And we're somewhat concerned at this point because it seems like a majority of those economists have now shifted more in line with what our outlook is, where we continue to see modest wage growth. We do believe inflation is going to reach the Fed's mandate by Q4 of 2024, and as such, we don't think that there's going to be a significant rise on the long end of the curve. And we're mentioning to our clients and advisors that they think that they should think about redeploying some of that cash that they've stockpiled
Peter,
over the past 6 to 12 months.
Does the spending of the U.S. government not concern you? I mean, we post-COVID are still running $1 trillion plus deficits every year. And we've already amassed such a huge debt. It's towering over our GDP. That's the kind of thing that would make me as an investor want to join the bond vigilantes and drive those long-term rates up.
Right. I hear what you're saying. I mean, certainly next year the politicians will be throwing stones ahead of the election, and there's going to be some volatility as it relates to the fiscal deficit. But still, at the end of the day, I mean, the U.S. Treasury is the benchmark yield, the benchmark asset around the world. So even if there are concerns over our fiscal issues, there's going to be a significant amount of demand from foreign governments, from large pension plans that will help keep yields at a reasonable level.
What are you saying about the fixed income space? Again, I'm kind of a scaredy cat after what happened in 2022, where there's no place left to hide equities or fixed income, and I feel like, boy, if I can get 5% for giving my money to Uncle Sam for a couple of years, that's not a bad thing.
That's absolutely how we're looking at it. So if you can get 4.75 on a 10-year Treasury locked in and clip that coupon over the next 10 years, we feel that's a much more attractive option than placing all your assets into a cash-like exposure that perhaps is giving you a little bit more. You're getting 5.25. But will that be 5.25 for the next decade? We don't necessarily think so. So that's why we've been advising our advisors to think about inching out in duration and locking in some of those higher yields for the next 10 years.
How much do you use ETFs, or how much do your RIAs use ETFs? Because when I came into the business, there weren't any ETFs. It was mutual funds. Now the ETFs are taking all the market share.
Yep, they certainly are. I believe asset-wise, it's split 50-50 at this point, with maybe just a little bit more in ETFs. We are seeing them, and we've seen a lot of core satellite-type portfolios, which the base is allocated to either index mutual funds or ETFs, and then advisors are rounding out that exposure with higher active share, higher concentration, active mutual fund managers. But certainly over the next few years, with the evolution of ETFs into the active space, we're really going to become product agnostic, where if there's a viable solution on the ETF side, if it's active, we can allocate to that. We'll take a look at active mutual funds, passive ETFs, etc.
Alternatives. Do your clients ask you about alternatives?
We do get
private
questions.
Equity or private credit or other kind of stuff?
Oh, absolutely. Both on the private and the liquid side. And the way we generally approach alternatives is that it's when we get asked, well, should I allocate to alternatives? It's kind of like saying, well, should I I'm hungry, I should eat food, right? There's many different types of alternatives out there, as you mentioned, private equity, private credit, there's managed futures, et cetera. So it really comes down to the type of exposure that you're looking for, the type of factor you're looking for in a portfolio. But certainly for higher net worth clients, we are seeing a greater interest as of late on the private credit side of things.
And that's where all the money's going, it seems like, private credit. All right, Peter, thanks so much for joining us. Peter Essele, he's our Senior VP of Investment Management and Research at Commonwealth.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.